Good evening, everyone. Welcome back to the channel. This evening, Howard Chan of Kurv Investments is our honorary first fund manager of the year 2025 to come onto the channel. So Howard, thank you so much for coming on and welcome back.
Thanks, Coach. Great to be here.
So to start off, if you want to just give the audience an overview of all the exciting things that are in the works for your funds, what drove the, as we all know, the increase in the dividend payments, and things like that, I'll let you go ahead.
Sure. Lots of things has happened with the Curve funds. I guess since maybe November month end. Uh, I think people who are investors in our ETFs have seen an increase in dividends. I think maybe uh, since actually the first time I've been on this channel, we've always talked about we try to balance between income and price appreciation. And so what we've seen is, you know, middle of November, right after the election, we've seen basically a surge in the markets with a
Yep.
lot of the tech stock names, right? And our funds was able to capture most of that price appreciation. And we always said that beyond what we can clip coupons from the calls that we write, if we have price appreciation, we'd be able to distribute that to the investors. So because we captured that, we were able to distribute a lot of that gains, capital gains that we got from, I would say, mid-November till the end of the year, even in recent months in January. So we're able to capture that, and we're distributing that back to the investors. So
Okay.
that's sort of the first development that we have in our funds. Yeah.
So would you say that was the main driver of the dividend increase was the surge in the market that we saw after November?
Yeah, if you take a
Okay.
look at one of the websites for one of the sites on our funds, we're pretty steady in terms of our income. That's one of the goals that we try to reach, and
Hmm.
then and so over the long period of time, we're going to converge to that rate. But when there's a moment where we capture more capital appreciation, I hope the investors don't mind that we basically distribute some of that back out
Oh, not at
to
all.
to the investors. Yeah.
Definitely not at all. Well, that's good to know. So we do expect like a reversion to the mean if the market continues to perform normally.
Yeah, I think so, but I think the vol has actually been pretty high. So we've been able to maintain some of the higher
Hmm.
rate going forward. So, you know, again, going back to what we said from day one is redistribute what the market gives us. So if the market gives us more, we will distribute that back to the investors. So that's always been our goal. Without we distribute without sort of NAV erosion. We
Yeah,
guard against that NAV erosion. So when we have more, we distribute back to the investors. Yeah.
and not to compare you to anyone, but I'm looking here from December and January. You've had $1.30 both months, and then $1 in February compared to Tesla. It's like double what they're paying.
Yeah, and that's reflective of if you look at what the Tesla stock did, especially post November, mid-November.
Hmm.
There's been a huge rise in terms of the price of the stock itself. So again, uh, just for those people who are not as familiar with us, we write our calls a little bit further out, so we're able to capture that price appreciation. And so once we capture that price appreciation, some of that short-term gains we will distribute that out back to the investors. Yeah.
Now, could you explain writing them a little bit further out in more detail? So you're going over like the 30 days where they have the rapid time decay.
Yeah, so I think one of the things that we try to capture in our fund is actually theta. Exactly what you mentioned is the time decay, because that's sort of it works for the investor, right? So the for people who are familiar with selling options is that the one force that you can have is that the value of your call, if it's out of the money, will always work in your favor the longer you hold it to until you get to expiry, which hopefully expires uh, out of the money, which means that you get the full value of the premium. So we try to harvest that premium as much as possible in our funds. And part of that is that we write generally about 6 weeks calls, but we roll every month so we can capture most of that data. But the other thing we do is we write sort of out of the money. So 30 delta calls for Tesla that's on your screen, that's usually means that about like 15% out of the money, which means that the underlying stock can appreciate about 15%, and we can capture a lot of that price appreciation before it's capped out by the call. And when we captured that amount of price appreciation, we were able to kind of distribute that back to the investors.
Right. And as I see here, you've definitely outperformed one of the other main ones, and you're actually not far behind as far as Tesla. As far as, I mean, we know the underlying's usually going to do better,
Yeah.
but I looked at year to date. It's actually outperforming Tesla right now in total return.
Yeah, we generally cover call ETFs will underperform when this underlying is moving very rapidly up, but it actually will outperform the underlying if it actually is falling. And so since the beginning of the year, Tesla has been actually falling. So some people actually use it sort of as a defensive mechanism because because when we write 30 delta calls, our sensitivity to the underlying is actually 0.7. So if the underlying decreases by 1%, we roughly decrease by 0.7. So we decrease less than the underlying stock. So we can catch up on total return of the underlying when the market is actually correcting in the market. Yeah.
Interesting. Any other news since within the last 4 months? Any new
Yeah.
funds? Yeah.
Yeah. So we have been hearing a lot of demand from investors about moving to weekly
Yes.
distribution.
hmm
Um, we still hold on to the principle. It's good to have some time to compound the capital in the fund to generate more returns for the investors. So we didn't change our how often and the frequency in which we distribute our funds. But what we have done is we have 7 ETFs, and we've staggered the schedule. So every single week in the month, one or two of the funds is actually distributing. So if you buy the set, you'll get actually a weekly distribution, similar, about the same amount distribution in your portfolio. And I think that's been kind of been positive for a lot of the investors that we've heard from.
Absolutely. That sounds very similar to what YieldMax did with the staggering of the dates.
Yeah, I think our principle is like we want to be able to generate monthly return, also maximize the return that we can give you. So the more time that it stays in the fund, we're able to compound the capital that's in the fund. But and quite frankly, we've been resistant to kind of moving into this weekly schedule because we're like, we can give you more. We can hopefully our goal, if we do everything right, we can generate more income for you if we have more time to compound the capital. But it was actually through feedback from a couple of other people who like the fund. It's like, well, why don't you stagger it? And that has, to us, doesn't affect the compounding effect of the fund. So we're actually we change our distribution schedule. So now that they're scattered in a way, staggered in a way that you can get weekly distribution.
hmm Yeah. So you have it on like the Tesla one, or the
Yeah.
Tesla one pays
So
week
the
one.
way
Yep.
that we determine the schedule, just if people care about that, is that the every week we roughly distribute about the same amount.
hmm
So Tesla is one of our highest distributing funds, so we keep that as itself. It's week one, so there's only one fund there. But if you look at the pair in week two, there's Amazon and Microsoft. Week three, there's Apple and Google, and week four, there's Netflix and KQQQ. The sum of the distribution is roughly the same in the long run distribution rate. So then, if you're somebody who cares about weekly distribution, you kind of get a similar distribution on a weekly basis. If you care about monthly distribution and you'll have one of the 7 funds, you still get roughly the same rate that you get before we have changed the distribution schedule.
hmm And then, so why Tuesdays for the declaration date?
Oh, we also heard that people. people preferred potentially getting a set of funds that distribute on Thursdays. So
Yeah.
if you get the payment date on Thursday, you back out like the number of days that you need to get to the payment date on Thursday. That declaration day would be a Tuesday. So
Okay.
typically, so right now the distribution schedule is we declare or on Tuesday, and then the record date is the day after, and the payment date is the day after that. So Tuesday, Wednesday, Thursday.
Okay. I was just thinking because a lot of the ETF companies do the same days, and I just wondered if, because I feel like the next thing's probably going to be daily. People are going to want like daily dividend payouts.
I know that's.
Yeah.
I think you can always push the envelope, but um, I think for us the decision was not to deteriorate the ability to generate income, and then meeting the demand or meeting the desire of the investors to have a weekly payment and also on a different date. So we were able to find a way in which we reach all three goals, and
Hmm.
that's fine. I think for us and just for anybody who, our investment philosophy is that we never want to deter our ability to reach the investment objective. That's
Right.
the first thing that we want to do. But if there's like secondary conditions that doesn't deter that objective, we're happy to work around and try to fit those kind of criteria. And quite frankly, um, we are responsive to the people who own our funds. We want them to, it's like a tech company, right? We want to find the use case. We want to optimize that use case. We want to make sure people are happy owning our funds and getting it on a schedule that they like without deterring the investment objective. So if we can reach all of that, we're happy to do that. And we've been um, we hopefully this is sort of a sign that like we listen to the people who are giving us feedback, and we can respond to those feedbacks.
Hmm. What do you think the feasibility would be for a daily dividend payer?
I think for us it would be probably not possible.
Yeah.
Largely because we from the very beginning, right? We write 6 week calls and then we roll them monthly. So our cycle is roughly monthly because we want to capture that data. And part of capturing data is time. You want the time decay, right?
Right.
If you're doing daily, um, you're you can't. I don't. It's difficult. I don't say. I never say anything is impossible, but it's difficult to capture that data in the fund, right? So
Yes.
it would be kind of going against our investment thesis. So I think that would be. Other people may do it, but I think it would be kind of hard for Curve to do it.
Hmm. Makes sense. Yeah, I'm almost certain we're going to see one from somebody.
Well, I mean, you could always distribute every day, but the
Yeah.
question is whether you're distributing from the capital that you're generating or the capital you're getting, and then you may run into NAV erosion. So that's the thing that we try to guard against NAV erosion. It's a very common thing that happens with high yielding distribution funds. In some, it's almost it's inevitably there's some erosion, but we try to guard against as much of that as possible. And I think the more frequent that you distribute, the more erosion you're going to get. And so I think that's sort of antithetical to what we're trying to accomplish, right? I think, to be very honest, like we kind of know the user set for our funds, right? People who want to get a steady payout, be able to supplement their income, right? That's been our feedback from the investors we have. And to have steady and consistent income, you need to be having a steady NAV, right?
Right.
So it would be antithetical for us to. I always say this example, right? If you give me $100 and I give you right back $100, that's 100% dividend rate. But I'm
Right.
not sure you're gaining much from that.
Yeah,
So
because
we
you're at
don't.
zero.
Exactly.
Yeah.
Exactly. So that's like the extreme corner case, right? For people who have like tech speak, right? That's extreme corner case. So I don't think that makes any sense for us at least.
Right. So what you just hinted at kind of reminds me of the return of capital concept. With these funds, do you know like what percentage is typically considered a return of capital, or have they figured that out yet?
No, it's typically done when the at the fiscal year end for a particular fund because
Yeah.
you have to basically a very simple explanation of return on capital is for any 40 Act 1940 Act mutual fund, which is an ETF. Most of the ETFs is you first have to distribute two types of uh, uh, things that funds generate. The first is net investment income, and the second is the short-term capital gains. If you after you distribute that, and then there's some sort of netting rules and stuff, that anything you distribute above that, it's considered return of capital. And
Hmm.
so for us, we're always trying to maximize the amount of return of capital we generate because the return of capital is not immediately taxable. So that is always a goal. But I will say, um, the the underlying stocks that we saw from the mid-November to the end of the year generated a lot of short-term capital. So the quality is not return of capital; it's short-term capital gains. But because we generate so much of those capital gains, we have to distribute that, and we hope some distribution is better than no distribution. And then
Right.
obviously we're trying to aim for tax deferred distribution versus taxable distribution. So that's always the sort of the hierarchy that we're aiming for.
Absolutely. I think just a lot of people are waiting for it for filing their taxes because it's obviously more tax efficient.
Yeah. Yeah.
Hmm. I finally found this comparison you have here. This is very impressive, actually.
Yeah. So we there's actually, if you scroll down, there's something we just added to the page that's actually new
Hmm.
because we realized we were wrong actually. We often compare our funds on total return,
Hmm.
and total return calculations actually embeds in an assumption that I don't think is always true for the users of our ETFs, which is total return assumes that you reinvest all of your distribution back into the fund.
Right.
So we know that some uh, investors in our funds use them sort of as supplemental of income, so they don't reinvest into the back into a fund, right? They kind of see it as sort of a flipping of coupons and getting an income source essentially. So it is not correct completely to assume that everybody reinvests. So what we have done is we put three scenarios, pretty simple scenarios of what the fund would look like if you reinvested zero amount of distribution, 50% of the distribution, and 100% of the distribution. And so I think these are more realistic cases for people who uh, use our funds, right? So yeah,
Hmm. Yeah, this is really good. Yeah, in all three scenarios, it's still overperforming, I would say.
I think that's the difference is really over distribution or NAV erosion.
Hmm.
So, if you have no reinvestment, right, you want to maintain your capital so that you can generate more income to be distributed.
Hmm.
But if you over distribute and it erodes into your capital, then the ability for you to generate more income to be distributed is less. And so I think there's actually a lot of very smart people on the community who have done this analysis through dollars, and we just show it through percentages.
Yeah.
So that hopefully is kind of a more realistic, real world example that people
Hmm.
can use. Yeah.
So with this, with no reinvestment of the dividend, this would just be pure price return.
Yeah. So if you just take a look at the price of the ETF, that's what you would have gotten from the inception till the end of January.
Oh, okay.
Yeah.
56%. That's very impressive.
But that we can't claim all of that, right? Our funds, TSLP, is dependent on the movement of the underlying stock. So a lot of that is also because of the movement of the Tesla stock, right? I want to give where credit is due, right? So when we have six of these cover call ETFs, there are six different stocks. So you kind of have to have a view of each one of the stocks, right? But here you can see that the stock of Tesla has done really well since inception. So we're able to capture most of that price appreciation, but able to also generate, because if you look at the no reinvestment versus 100% reinvestment, right? There's sort of a roughly 15% difference, right? That's roughly the difference in distribution, essentially, right? That you're getting. So the income return is about 15%. The price return is roughly about 15% return, right? So we're able to kind of capture a lot of the price appreciation and then generate additional income return for the investors for ETF that tracks or at least the underlying is the Tesla stock.
Hmm. Yeah, when I'm looking at just price return, I'm seeing different numbers. Um, so that's interesting, especially for Tesla, because that was November of 22.
But the inception is they have to have the same time. So you have to take a
Oh,
look at
that's
from
as of, yeah.
exactly, yeah.
Okay,
So for
okay.
October 31st, 2023 would be the same period because they're doing if it's different period, then it's not the right comparison, right? So we're trying to reach the same comparison. Yeah.
I see. I see. Okay.
Or else it's what we want to do apples to apples comparison, or else it'd be
Yeah,
slightly different. Yeah.
true. Okay. Interesting. Um, what would be really helpful too to have on your website would be like a dividend calculator, like a dividend reinvestment calculator.
This is a sore point. We actually wanted to create a calculator, but our compliance says it's simulated data, which is not allowed. We're
Really?
going to keep pushing for it because it's actually dividends that we have already distributed. So historically, it's accurate, right? Like if you
Right.
know all number of shares, this would have been like the amount of distributed. So we actually have thought about that because we get a lot of questions of saying like, hey, if I get like different pairs of your ETFs, what would have been my distribution, right?
Right.
That
Right.
that because if you're thinking about hey, I might need X number of dollars to supplement my income every month. What would that look like between the different pairs? That's actually the original intent of us building the calculator. We got X'd on compliance. So we're gonna,
Okay.
well, I think we're gonna, I think it's a useful tool. I think maybe, well, we'll try to figure out if we can actually do that. Yeah.
Okay. Yeah, that would definitely be helpful. Okay, question from the audience. Is there a fund of funds ETF or an index, S&P 500 or NASDAQ 100 coming out for Curve?
I know we've been getting that a lot of questions. I
Mm,
would just say this. Uh, we are thinking about it, but we want to do it in a way where it's sustainable and um, we have an edge in terms of managing an ETF. So I we don't have a final idea, but we are definitely debating different things at first.
okay. Your KQQQ fund is kind of like the NASDAQ 100 one right now.
Yes, so
Hmm.
that's a basket of the largest ETFs, and actually most of them are kind of AI related. So they this is meant to kind of capture the size premium that's happening in the market that generally large tech companies outperform the market because they're
Yep.
essentially monopolies and so that is more I would say for people who are focused on growth versus income. What we try to do with this fund is focus more on growth, but we also distribute roughly about 7% of distribution. So we have this balance essentially when the market goes up, the fund leverages price return, and then when the market goes down, it leverages income return on the fund.
Hmm.
So it's a little bit dynamic. It's not the same as a traditional cover call ETF. Basically what we want to do is a traditional cover call ETF will always underperform because it caps some of the upside. And we wanted a fund that doesn't necessarily uh, cap the upside when the market is going up.
Yeah, exactly. And a lot of people want that too. They get frustrated that the upside is capped. Um, okay, next question is going to be from me. So do you plan to do any leveraged ETFs?
We can actually do a little bit leverage in KQQQ. We can go up to 150%, but it's in a basket format, so it's a little bit uh, diversified, I would say. So one of the things, um, and I want to say our philosophy, and I think we're maybe changing a little bit of our mind, is that we generally at Curve we launch things that are considered strategies instead of trades. And
Hmm.
the difference with strategies and trades is like a strategy should be able to navigate different market environments, right? Versus a trade is like, I know it's very popular for like Palantir or something like that, right? Like I think Palantir is going to go gangbusters. I'm going to get two times leverage and get as much return as possible. But the thing is that that trade has only a limited time of a life, right? Because at some point, maybe there's a mean reversion. Palantir is mean reverts and falls. Then people kind of move out of that particular trade, right?
Yep.
So we generally look for things that are that be able to navigate different market cycles. What happens if Palantir falls, right? Like, is there something we can do to minimize the fall? And if Palantir is going up in price, can we maximize that increase in price, right? So that is always sort of our theory. Is like, we want to be able to do something in different market environments. So we don't have any plans for single name leverage ETFs, but we are thinking about maybe um, we can do something with leverage, but that can navigate different market environments. So that's definitely something that we're working on for sure.
Okay. Good to know. So this can go up to 150%, you're saying, with the KQQQ?
Yes.
Interesting. Now, how so if you chose to do that, like how would that happen?
It would be using options. So one of the beautiful things about options, we could have asymmetric upside versus downside.
Hmm.
So for instance, this is just an example. It's not what we have in the portfolio. It's like if you have a stock, you can buy uh, X number of puts. You can sell number of puts to get the downside, right? To mimic the stock, but you can maybe buy 2x of the calls. So your upside and downside is actually asymmetric. So you can capture potentially magnify the upside and then only have one-to-one linear relationship with the downside. So that's actually some of the things that we kind of built in to think about how can we get leverage, but not the same when the market is going up versus going down. I think that's the beauty of options, where it's like relationships of up and down markets can be not linear. So yeah,
Okay, yeah, that's interesting. So asymmetrical increase versus decrease with options. Very
yeah.
interesting. Okay. So this year, let me see, how can I ask this? So I know pretty much you always have new funds in the works. Um, any expected anytime soon this year?
Uh, we have a set of funds that we are working on right now, of which we will file. So I
Okay.
can't quite talk about it, but we
Yeah.
definitely are planning for new, interesting funds for folks. I I I I will just say what we won't do. There's 13 Bitcoin ETFs. There's many single name ETFs. We don't need another one, right? So we
Uh,
want to do something that is a little bit unique, that's
mhm.
going to be able to um, actually capture some risk premia that is in the market that maybe other people have not thought about.
Okay. Yeah, that's this one guy here, his question, any crypto fund. Um, yeah, like you said, it's kind of saturated.
Yeah.
What about any like inverse funds?
Um, we so we have thought about that, but inverse funds still tends to be trades, right? Because if they're mean reversion, you're just going writing down. They're essentially the opposite of leverage fund.
Hmm.
What we are thinking about is if the fund goes down, what sort of protections we can put on the particular name to minimize the. So we're kind of taking it in a different approach. We want to, again, sort of this philosophy of being able to navigate different market environments. So in your case of the inverse funds, essentially you're assuming the market is going down, right?
Yeah.
So how can we actually capture that downward motion, right? So we don't necessarily have to launch inverse funds in our funds. Maybe we can actually buy puts to protect the downside and gain capital gains from that perspective. So I think we're trying to not do trades, but to do strategies in our fund.
Makes sense. Makes sense. Okay, well, we were kind of light on questions today, so I think we went for 30 minutes. We'll just keep it at that for now.
Okay.
So, yeah, thank you so much for coming on. You're always welcome on anytime. And oh, one more. Uh, any NVIDIA or MSTR? There's a lot
So
of
we
these
had,
too.
yeah, I know. So we've been resistant in doing NVIDIA because we thought for a long time, and I think it's the case that you should just hold the stock, and if you want income, you just sell a bit of it. But now it's kind of coming to a point in which, uh, again, a cover call NVIDIA cover call strategy is really great when the stock is trading sideways but high vol, or it's going down, or it's moving up very slowly. And I think we're kind of getting to a point in which there's like a different regime with NVIDIA stock. So uh, I would say it's from a probability of like 1 to greater than that. So for Curve, yeah.
Okay. We had a few people. They heard I was trying to end it, and they kind of submitted questions at the last minute here, but
Yeah.
I'm not sure what this one is. Defined outcome.
Yeah, so like sort of we are definitely, so with defined outcome, you're always setting what the outcome is, right? I think we want to be a little bit more dynamic, but we're definitely working on that front as well. That we want to be a little bit dynamic because the thing, um, I would say the weakness with defined outcome is with options is if you understand this term is path dependent.
Hmm.
So, for instance, when you write an option, depending on where you come into the fund, your payoff structure is very different, right? So, like if you write a call right now at the money, uh, it's a different structure than if, say, this underlying moved up and then you're coming in the money in the call already, right? So that's always been sort of a issue with defined outcome, is that your outcome is different depending on when you come into the fund. So what we want to try to do is be a little bit like that, more dynamic, and think about how do we navigate how all of these funds that the outcome of the fund without being necessarily dependent on when people buy the funds.
I didn't even know there was such a thing. That's very interesting.
Yeah. So for I'll give you an example. If
Hmm.
uh, if if uh, if you write a call right now at the money, right,
Hmm.
and you come into the fund, you get all of the upside because you're from the strike up to wherever, right?
Hmm.
But if you come into, let's say the fund, if the underlying sells off by 10% and you come into the fund, you're not in the money until the stock goes back up 10% with the call, right?
Hmm.
So your outcome is actually very different than the first person. So it's actually, that's one of the things that people should be aware of with options.
Fascinating. Yeah, that's definitely something that we'll have to look into further. But anyway, well, Howard, thank you so much for coming back on. It was great having you back on today. Glad you were the first fund manager of the year to make it on. You're always welcome back on. And yeah, any last comments?
No, I just want to say for those who are, have uh, believed in Curve, hopefully um, our returns and our philosophy has reflected that trust. And we're going to continue to improve our funds. And I know this question about fund overload, we're only going to launch funds where we think we can outperform what our our investment objective is. So I
Yeah.
think we've been at 7 for a long time, and
Uh-huh.
so we're working on things that we think can bring value instead of just having another fund um, that's in the market. There's too many funds, right? So we don't need
Absolutely.
more. Yeah.
And I think the results do speak for themselves. That's very impressive. So, all right. Well, thank you again to everybody on here. Like, comment, and subscribe. Join Discord and check out Curve Funds. And have a great evening. All right.
Thank you.
Thanks again, Howard. Yep.
Bye.
Take care. Bye.